It's time now for today's strategy session. Investors are grappling with the biggest market sell-off of the year, with several Wall Street strategists souring on U.S. stocks. Citigroup strategists downgraded their view on U.S. stocks to neutral from overweight, citing expected negative U.S. data prints and uncertainty over tariffs and government job cuts. So how should you position your portfolio? Joining us now, we've got Anthony Saglimbene, who is the Ameriprise Financial Chief Market Strategist. Great to have you here with us this morning. First and foremost, as you think about some of the changes in position that we've seen, even from that of Citi to kind of muted on the U.S. exceptionalism trade that really kind of rattled through and was the consensus on the street, how is that shifting your own strategy right now?
Yeah, thanks for having me. The last couple of weeks have been very difficult for investors from an equity perspective. Yesterday was obviously a very difficult day. You saw Mag 7 collectively move into a bear market. You've seen the NASDAQ move into correction. You've talked about some of the technicals. A lot of the major indexes violated their longer-term 200-day moving averages. And I think a lot of it is the market reaction to some of the tariff uncertainty we're seeing from the White House. So the market, I think, is making a judgment that these tariffs, and in the degree that they're being discussed, is likely bad for profits and it's likely bad for the economy. We haven't seen that translate into economic data, but coming into this year, the U.S. economy was on firm footing. We just got the employment data last week, created 151,000 jobs in the U.S. economy. Unemployment's low. Consumers continue to spend. We'll see how that plays out in the first quarter. But the profit situation for U.S. companies was very strong in the fourth quarter. And even though those outlooks have come in over the reporting season, analysts still expect the S&P 500 to earn around 7.5%, which is still a pretty strong earnings number. So our view is there's likely to be volatility in U.S. equities for the, probably the near to intermediate term. But our fundamental view on the U.S. economy and U.S. markets still remains solid.
So if your view remains solid, then at what point in this dip do you see and tell investors to get back in, to utilize the dip as a buying opportunity?
Yeah, that's the question everybody's asking, right, from an investor standpoint. And it's very difficult in the moment to kind of determine where the buying opportunity lies. But when you start talking about an S&P 500 getting close to correction territory, trading below its 200-day moving average, the NASDAQ composite moving down around 14% from its all-time high, longer term, those are typically good buying opportunities if the U.S. economy doesn't move into a recession and corporate profitability remains on track. A lot of questions about how tariffs are going to interact and interplay with those dynamics, but generally from a longer term perspective, investors probably want to be putting their shopping lists together. They want to be looking at equities if they have cash, excess cash on the sidelines. One of the things that we've been telling our clients and advisors is have a plan for addressing the volatility. Right now, a well-diversified portfolio of stocks, bonds, cash, alternatives is helping insulate some of the risks in equities today. And longer term, there will be opportunities that are created in some of the secular leaders. You guys just touched on some of the Mag 7 names that have seen a tremendous amount of pressure over the last couple of weeks. These are the secular leaders in the U.S. economy. And at some point, their valuations will become low enough where investors will look at these opportunities and those valuations and look at their growth rates and maybe put some money to work. And so I think over the next few weeks, the market's going to be volatile. It's going to be very headline driven by the tariffs. But as long as profitability remains solid for U.S. companies and we don't see a deterioration in the economy, this type of volatility historically is a buying opportunity for investors longer term.
And so I guess the larger question, and one that we've brought up earlier on in the show, and as Maddie had raised, is what is that catalyst? Because it's more than just, hey, there's a massive dip or massive pullback here. Buy in and hope for the run back up because, of course, over time, we all know markets tend to go higher. But it's that time horizon that investors would have to be banking on to making sure that their time in the market is valuable enough and that there's catalysts that emerge on the other side of that. And so is it clear right now where those catalysts will be? Because a lot of the Mag 7 names that had really been kind of encapsulated within that AI trade have now seen their own retracement, which sends the larger question of, should people buy further into those names or should they go into the safe havens like they typically do at a time like this?
Yeah, you're absolutely right. And it all depends on your time horizon. I think over the next few months, the investing environment is going to be difficult. And so having, appropriate levels of cash and fixed income and alternatives can help blunt the volatility in a portfolio. Obviously, more defensive sectors of the S&P 500, like staples and healthcare and utilities, can help blunt some of that volatility. And you're right, you need a catalyst to help reshape the market sentiment, which is quite negative right now. And so I think some of those catalysts will include more announcements on tariffs. I mean, like I said earlier, I think the market is clearly sending a signal to the White House that these tariffs are bad for growth and bad for the market. If we see the White House back off some of these more extreme tariff rates, then I think that could be a catalyst to move the market higher. And then obviously the earnings season in April and May will be a big indication of where investors feel confident about putting money into the market.
All right, Anthony, got to leave it there. Thanks so much for joining us.